morning. My name is Shannon Desaulniers. I'm a licensed insolvency trustee with Hoyes Michalos. And just bring this up now. All right, so today we're going to talk about getting help with your debt. It's very easy to get into debt, and people can be overwhelmed by different amounts. One person can feel overwhelmed with $5,000 in debt. Someone else might feel overwhelmed with $10,000 or $20,000 of debt. And it's all a matter of, when do you reach out and ask for help? So we're going to talk about, when to reach out, what to expect when you do make that appointment with a trustee, and what options are available to help you deal with the debt. So the amount of debt, not that it's not relevant, but whether you can service that debt or not is the actual thing that's relevant. And so there's some warning signs that may indicate that there are some debt problems that you should take a look at. So if you're making just minimum payments every month, you're not able to pay the debts off in full, you're not able to maintain any savings, if you've applied for new credit and you've been rejected, if you're getting collection calls or letters, if you're using credit to pay other debt, whether it's cash advances, payday loans, if someone's threatening legal action, someone's actually gone to court, gotten a judgment, or your wages are being garnished, or just you're feeling stressed, you're losing sleep. It's a matter of, maybe it's time just to talk to someone and see what options are available. What happens when you can't pay your debt is that you're charged additional fees. So there's interest. If you're not paying your debt in full every month, you're getting charged interest every month. When you start missing payments, then you can get, threatening calls, threatening letters. There's the risk of legal action. The lower your credit goes, the more limited your credit options are, which means that you're looking at even higher interest rate loans, and it reduces the amount that you have available to pay your regular expenses and to pay off your debt. So that's when it's time to reach out. When you do look for help with your debt, it is important to look for someone that is licensed. So licensed insolvency trustees, our licenses are through Industry Canada. So on the Superintendent of Bankruptcy's website, there is, which I have on here, where there's a site where you can actually search for a licensed insolvency trustee. So you know who you're talking to is a professional. It's just saying beware of questionable debt consultant tactics. There are some unregulated debt consultants, and the reason to beware is just because you're going to be charged fees. Sometimes you're charged a fee to help you file a proposal, which can only be done through a licensed insolvency trustee. A lot of times you're charged a fee before you're getting any protection from your creditors. So you've reached out to your trustee, you've made your appointment, and then what do you expect at that appointment? So usually when someone comes in and it's saying, first of all, let's talk about the situation. What brings you in? There are many different causes of debt problems. It can be, simple overextension of credit. It can be a relationship breakdown, health-related issues, job loss, or reduction of your income. It can be business failure. And the beginning is just kind of saying, what brings you in? What is your specific circumstances? And sometimes there's a key event that may prompt someone to reach out to a trustee, and it's just taking a look at that first. Then we're going to look at, what debts do you have? So what do you owe and what do you own? So who are your creditors? Who do you owe? How much do you owe each of them? On all of the debts that you have, is anyone joint? Is anyone joint debtor, or is someone guaranteed? Is there a co-signer? Does someone have a second or supplementary card? If there's anyone else's name on the debt, then we want to address it, because maybe it's a matter of doing something together. Are there any judgments? Are there any garnishments right now against your pay? If you file a bankruptcy proposal, there's an automatic stay of proceedings which can stop those. Is there student loans? If there's student loans, we want to look at, how long have you been out of school? If you've been out of school for less than 7 years, then the student loans are debts that do survive. So we want to take a look at any potential debts that may create some issues. Then we want to look at your assets. Do you own property or do you rent? Do you have a vehicle? Any investments? RRSPs, RESPs, tax savings accounts, stocks or bonds, life insurance? Is there any recreational vehicles, boat, trailer, motorcycle, anything like that? Do you have other real estate, land, cottage, any assets or bank accounts outside of Canada? When we look at your situation and look at the options, we want to look at everything so we can say this is what would happen in any scenario. So we have to look at any assets that you have that could potentially go towards paying off your debt. The next thing we're going to look at is going to be your income and expenses. So we want to look at, how often do you get paid? Are you paid weekly, bi-weekly, semi-monthly, monthly? So we can get an average amount of what your monthly average income is. I mean, if you're paid bi-weekly, you're looking at having 2 months of the year where you get 3 pays. We want to look at what your total average income is for the year. We want to look at all sources of income, which includes your HST checks. It includes Trillium benefits. It includes child tax benefit. It includes, if you get child or spousal support. Even if you have income that's not taxable income, it still counts as income under the Bankruptcy and Insolvency Act. So we want to look at all sources. We also want to look at who else in your household has income and what that total household income is. Then we want to look at your expenses. We want to look at whether you have, child or spousal support payments, child care expenses, medical expenses that you're claiming on your taxes. Then we want to look at your regular expenses, and those are the ones that you already know about. You have to pay rent every month. You have to pay your utilities, your phone, your groceries. We also want to look at your irregular expenses, ones that you don't have every month, but you still are going to have in a year. We want to look at, what do you pay for gifts for family and friends, for birthdays and holidays? What are you buying in clothes in a year? Grooming and toiletries, car maintenance, your registration that you have to renew every year. Those are things that if you're doing up a budget are things that you maybe don't necessarily automatically list down, but we want to make sure that we're including everything so we get the most accurate picture of your budget as we can. So once we've gone over all of that, then we get into what options are available. So anyone that has debts is going to fall into one of 2 categories. Either you can pay your debt on your own or you can't. If you can pay your debt on your own, we're looking at, is budgeting your way out of it, which is why we go through all of your income and expenses to see what's left at the end of the month. Is there enough there to service your debts in full and you're just looking for a plan or not? So we look at budgeting, then we look at, if not, are you eligible to get, to borrow the money? Do you have any assets you could potentially sell or borrow against? Those fall under the can pay it on your own category. If you can't pay it on your own, there's a debt management plan, there's a consumer proposal, and there's a bankruptcy. So for the debt management plan, that would be where you can pay your debts in full. You just want to get a bit of a break from the interest. So it's a way to pay back everything. Usually what they do is they offer all of what you owe plus 10 to 15% or so for the credit counselor's fees. And then they send that off to everyone that's owed money and say, hey, hold off on the interest and you're going to get paid in full. With the debt management plan, every one of the debts owing, they do have to agree to this plan. Otherwise, they're excluded from it. This one is a good one where your debt, you pay more in a bankruptcy, or you have a small amount of debt where the bankruptcy maybe doesn't make sense, or you have very few creditors, so you don't have as many people that have to agree to it. Other options, so the options that we provide are under the Bankruptcy and Insolvency Act. So under the Bankruptcy and Insolvency Act, there's 2 options. One of them is bankruptcy. The other one is a consumer proposal. So in order to be able to file either of them, there's a few criteria. So you need to owe at least $1,000, that you are unable to pay those as they generally become due, or you owe more in debt than the value of the assets that you could otherwise sell to pay them. and you need to either reside, do business, or have property in Canada. So between those two options, there's the bankruptcy and the proposal. What I do is I kind of usually start at the bottom and then work my way up. So I look at bankruptcy first, and then I look at proposal. So in a bankruptcy, what happens is there's monthly payments that are based on your income, and there's payments based on potential assets. So in a bankruptcy, there are assets that are exempt, and then there are assets that are considered seizable. Now, any assets that are considered seizable, it doesn't mean that you automatically lose those assets, but it means that the value of those assets has to be paid into the bankruptcy, whether by being sold or whether it means you pay extra. So that value still has to be paid in. So we're looking at if you have equity in your house, if you have any property, there's exemptions for a vehicle up to a certain value. If your vehicle is worth more than that, then you pay extra. We look at the investments. If you have RRSPs, most of them are exempt, except for the contributions you would have made into an RRSP within the last 12 months. Our ESPs are considered fully seizable, but just the portion that you've put in and the interest, the government portion can't be seized. The government would just take that back. Tax or savings accounts, those are also seizable assets. So we look at monthly payments based on any assets that you're buying back. And then there's also payments based on your income. So the government has guidelines based on how many people are in your household. And the guidelines are just to say an average household can live reasonably at these guideline amounts. If your income is above that amount, then what happens in a bankruptcy is you pay half the difference. So for example, if your income is $500 higher, your payments are $250. It just depends on what your average income is during the bankruptcy period. That determines your payments. In addition to the monthly payments, there will be 2 budget counseling sessions to attend in a bankruptcy. There are a chance to check in, chance to talk about budgeting, chance to talk about money management, and then a chance to also talk about ways to rebuild credit. There's monthly budget sheets to fill out. So when you're in a bankruptcy, you submit monthly reports that show what your income is each month and what your expenses are. And there's 2 reasons for it. One, because your monthly payments are based on your income. That's a way to track the income. And 2, the Bankruptcy Insolvency Act is a rehabilitative act. So it's meant to say, track your expenses, and it'll help you going forward so you see exactly what you're spending. It allows you to decide where you want your money to go after you've tracked it, so you can decide if you want to change anything. The last thing in a bankruptcy is income tax information. So when someone files a bankruptcy, we have to split their taxes into 2 parts. The first part is January 1st until the date of bankruptcy, and then the second part is the date of bankruptcy until December 31st. So if someone owes taxes right up until that date of bankruptcy, they are part of it. And if they owe taxes from the date of bankruptcy until the end of the year, then that they would still have to pay. And if there's a refund in either part of the tax year, then that would go into the bankruptcy. So as long as everything is completed in the required amount of time, then you're eligible to be discharged automatically. Once you get your discharge, that means that you are out of the bankruptcy. Your debts can no longer be collected, and then it stays on your credit report for 7 years afterwards, assuming it's your first time. There are some debts that can survive. And that would include court fines or penalties, debts due to fraud. If you owed money for child support or spousal support, those are ones you can't go bankrupt on. You would still need to pay those. And with student loans, if you've been out of school for less than 7 years, then the student loans would still be owing. Outside of the bankruptcy, then the next option that's available is the consumer proposal. So to file a consumer proposal, it always has to be better for the creditors than what they would get in a bankruptcy. Because the proposal is a settlement offer to the creditors. It's saying, I can't pay my debts in full, but I can pay something. And then they have a chance to vote and say whether they want to accept your offer or not. It can be monthly payments, it can be a lump sum payment, it can be a combination of the 2. The most common is monthly payments. It's no longer than 5 years for a consumer proposal. That's the maximum length of time. Happens is we submit the offer to the creditors, and they have 45 days to come back and say, yes, we accept your offer, or no, we don't. The end of the 45 days, we count up those votes. Every $1 that's owing is worth 1 vote, and we need a majority to say yes in order for that proposal to be accepted. If we have a request for a meeting or we don't have that majority saying yes, we have a meeting of creditors 3 weeks after that 45-day period. What happens if we don't have the majority saying yes is it opens up the negotiation. That's where they say, you know, we don't accept your first offer, but we like the idea of a proposal because we know we're going to get more than a bankruptcy. But instead of what you've offered, we want this much more. And then it's a little bit of back and forth with what they're asking for and what the person that owes money is actually willing to pay. And that's another part of why we go over all the income and expenses in advance, because we never want to do a proposal that's going to set someone up to fail. We want to make sure it does fit into their expenses, and we've counted for all of the expenses that they have in a year to say there's still money left over to be able to pay it. Once the proposal is accepted, we have the majority saying yes. There's 2 budget counseling sessions to attend as well. Once the proposal has been paid in full, then it stays on your credit report. Rule of thumb is about 3 years. The credit reports have said that, or the credit bureau, sorry, have said that they may come off a little bit earlier. We're just kind of waiting to see what that is, but I would say anytime there's a consumer proposal, expect that it would be on your credit report for between 6 to 8 years. With the consumer proposal, none of the assets get seized. So any assets that are seizable in a bankruptcy have already been factored into whatever the payments is going to be. But if you come into any assets during the proposal, they don't automatically go into it. Once the proposal gets accepted, it is a binding settlement with the creditors. So if your income goes up, they can't come back and ask for more. Whereas in a bankruptcy, the payments are based on your average income. So if your income goes up, your payments go up, and if your income goes down, your payments go down. Proposal stays the same amount regardless. So that's where we go over all of your assets, all of the debts, and your income and expenses to look at which option makes the most sense for each person. There's benefits and drawbacks of both of them. The bankruptcy, if your income goes up, you're going to pay more. If your income is over the government's threshold for first-time bankruptcy, you're in bankruptcy for 21 months. And if you're under the government's threshold, you're in bankruptcy for 9 months. There's a possibility your bankruptcy can be extended to the 21 months if you earn more money. Not meant as a deterrent not to earn more money, because it still means you're keeping more in your own pocket. But that's sometimes a deterrent from some people, because they say, well, if I earn more money, I don't want to pay more. So the proposal sets the amount at the very beginning. But the proposal, you are always paying more than you would in a bankruptcy, because you can't do a proposal unless it's offering more than a bankruptcy would to the creditors. The proposal protects your assets in that nothing is being seized, even though the value has already been factored in. So if someone has equity in their house, then usually they will choose to do the proposal because it sets the amount of your payments at the beginning. In a bankruptcy, your equity is calculated at the beginning, and then it is also calculated again at your discharge date. So if your equity increases over, say, 9, 21 months, or if it's a second-time bankruptcy, 24, 36 months, well, likely your equity is going to increase, and it's going to mean that you're paying more into it at the end. And that's why a lot of people will choose to do the proposal when they have equity, because then they know exactly what they're going to be paying. Once it's accepted, that's what they pay. In the proposal, you do have the option to pay it off faster. So if your income goes up, your budgeting is going really well, you've got some savings set aside, and you want to put extra money on the proposal, it's always an option. There's no penalty for paying it off faster. There's no discount. You pay the amount that they've accepted, and then you're done. That's pretty much what we would go over at a first meeting. Look at circumstances that brought you in, look at your income and expenses, your assets, your debts, then go over the options. And we still go over the non-Bankruptcy Insolvency Act options if those seem like they could be a better option as well. And then after your first meeting, you go home and you think about it. There's no pressure to make a decision right then and there. It's a lot of information to take in a pretty short period of time. So usually it's nice to have a little bit of time to digest it. Once you've decided what you're going to do, then we would have you in for a second meeting and you'd sign the documents. Now, if someone has a bank that they owe money to that they're still banking with, there's some homework to do in advance before you want to file anything. You want to open up a new bank account. If you're banking with a bank that's owed money, the reason you want to open up a new bank account is because the banks have a right of offset. So if you deposit money with them, they owe you that money. If you also owe them money, they can offset it. So I always want to make sure that you're protecting your income going forward. Want to make sure that there's as few issues as possible once you file that can come up. So you would want to open up a new account and then have all of your incomes going into the new account first. Anything you're keeping, if you're keeping, you're keeping your car, you want to keep making the payments, you want to transfer those payments over, transfer insurance payments over. So there's still a little bit of a few things to do before you actually start the process. Should you decide to do the bankruptcy of the proposal, the day that you actually sign the papers, it gets filed electronically. Once it's filed electronically, it is effective immediately. There is a stay of proceedings in effect once you sign, which means that everything stops. The interest stops. No one can try to take any action against you. So no one can try to take you to court. No one can garnish your wages. If someone was garnishing your wages, it will stop. Once you've signed, all of the creditors are notified within 5 business days, and then the calls should stop shortly after that. And then you do the duties in the bankruptcy, make your payments in the proposal, and then once you're done, then the focus is on moving forward and looking towards getting that fresh start. We have your budget sessions. We talk about ways to rebuild credit. That's the big one, is getting out of it and moving forward and building that new credit. And we look at setting financial goals. My favorite part of the budget sessions is when you're no longer making these payments, what do you want to do with your money? Saving for retirement? Yes. Emergency savings? Absolutely. Do you want to save then for, for a vacation? Do you want to save for a house? Do you want to save for a car? What do you want to do with that money when you're no longer putting it towards your debt? And that's everything that we do is all focused on getting that fresh start.